in their investing journey and answer questions, of course, along the way. So yeah.
Sure, sure. So, I'll go ahead and ask some questions, and keep posting your questions in the chat. And at the end of the podcast, I'll go through the chat, and we'll take all the questions as we can. Alrighty. So, for someone new to estate investing, Parker, what advice would you give them when it comes to securing financing?
It's a great question. So, the very first thing I would say is don't listen to anybody on Facebook. Stay away from lending advice from non-loan originators. I mean, I say that in jest. Sure,
Yeah.
absolutely hear what people have to say, but make sure to speak with somebody who's qualified and really knows what they're doing, just because there's a lot of bad information. And I've had some panicked people come to me who were totally fine. So, because when it comes to calculating debt to income ratio and the different products and programs that are out there, everything's very specific to the borrower. So, like, for example, I know I've had quite a few physicians lately that I understand that you have sometimes there's different, I guess, hospital administrators that come in and take over payroll. Sometimes people get pushed to a 1099 versus W-2, so there are products and programs to accommodate almost every situation. So advice on short-term rental lending would be definitely speak to somebody who's qualified and versed. You don't want to talk to just any lender though, because a lot of loan originators focus on primary homes and they may not be as well versed. You want to speak to a loan originator who does a lot of investment, second home, long-term, so forth.
Yeah, that's what I love about Parker, because she is an investor herself. So she kind of understands where we are coming from, and she deals with lots of physicians and high income earners. So she really knows, and her team really knows what they're doing and how it's going. I've had when I started my real estate journey, I didn't know better. So I was going to lenders who were just, primary home lenders. And they were like, okay, it's your third short-term rental, it's like they're, like, just do what you need to do. So that's awesome. So yeah, a lot of us are interested in knowing, what is the difference between second home loans and then investment homes. So there are two different loan products, and how do they differ? What kind of things should we go to for that?
Yeah, absolutely. That's a great question. So one of the beautiful things with the short-term rental loans is a lot of times they're being purchased in areas people vacation, obviously. And so it can oftentimes fit into the box of being a second home loan. So it can be a second home, and you can also rent it for amazing income. The benefit to the second home, at least conventional loan products, so this means a loan amount up to $766,000 in 95% of the country, you can do 10% down, which is awesome. And it's for preserving capital, to keep it for investing in other places. So that 10% down product is really nice. The 10% down jumbo isn't so fantastic these days. I'm hoping that comes back around as rates kind of settle down a little bit. We have a decent 15% down jumbo option, but if you're going jumbo, those bigger ones, the 20% down second home, of course, is still a great product as well. But yeah, so the second home, that 10% down, that's the biggest benefit conventionally. Now, investment occupancy is 15% down minimum. And that's again up to that loan amount of 766. And then the jumbo is 20%. But what's really neat about the investment occupancy is that we can use projected rental income. So if somebody's made a couple big real estate purchases and hasn't gotten the rental income filed yet on tax returns, then we can use projected rental income from the property to help offset the debt to income ratio. So it's an awesome tool to use in that scenario.
Right. So when you say the rental income can be used, does it have to be where you have had filed taxes for that property and you've shown that income, or can it just be projected income?
So if it's a property you already own,
Mhm.
if it's a short-term rental, we do have to have at least one tax return reflecting that income.
Mhm.
Now, there is a formula on that income. So a lot of times you're taking the big, like the cost seg deductions from it. And so the net may not look good on the taxes, but that's okay.
Mhm.
Because when we do the calculation for that property, we're going to add back taxes, the expense lines. We'll add back taxes, insurance, mortgage interest, and all of that depreciation as we do our calculations.
Mhm.
This is why I try to encourage people not to try to figure out their own debt to income ratio, because it's hard. Yeah, it's
Yeah,
not easy.
right.
Let us do the hard work for you. So yeah,
Right.
so just one, and then if it's a long-term rental, we can actually use a lease agreement. So if it's a long-term rental, we can use 75% of a lease agreement right away.
That's good to know. So there's that difference between the short-term rental and the long-term rental.
Correct.
Perfect. Also, while we're on this topic, a lot of people ask us that, can we own multiple homes with 10% down? Or do we have a limit to that? Or what's the criteria between one home that we own as 10% and then we're getting into a second deal? What does that look like?
Fantastic question. So in the same market, it doesn't typically make sense to have more than one second home. So for example, the Smoky Mountains, if
Mhm.
if you purchase one as a second home there, typically you wouldn't be able to purchase another, but you could at that point do investment occupancy, that 15% down product. Now, you could though go to another market. So say you went to a beach market or another area, you could then do another second home in a different market. It just has to make sense, basically.
Mhm. Mhm. Right, right, right. Also, because when we do 10% or 15%, we do need to pay the PMI.
Ah,
And some people are in a, where they were trying to compare the 10% with PMI versus, paying 20% down. Obviously, with 10%, you also have to, maybe pay some points sometimes, to bring the interest rate down. So how do you look at that, that comparison with the PMI?
yeah, valid. So what I tell people, I always encourage if you have the capital and you don't really have anything else to do with it, I always encourage 20% down.
Mhm.
But if if you have a certain amount of capital or you're trying to save and you have other places you'd like to invest that, so maybe your goal is to purchase, 3 properties this year,
Mhm.
then I think it's an appropriate time to conserve the 10%. So if you can save 10% because you have plans for it,
Right,
then the PMI is usually pretty minimal.
right,
And I think a lot of people are surprised when I tell them how much the PMI is. And again, whatever you do, don't use the Zillow PMI calculator. I don't know why, but it will really scare you.
right, right,
So yeah, the PMI doesn't tend to be too bad. That being said, though, if you have nothing else you plan on doing with your capital,
right,
by all means, put
right,
20% down.
right, right.
Yeah.
Perfect, perfect. Yeah, I've had it both ways. And like you said, I've had a PMI of maybe 50, $60 a month. So that's not too much. And where I can save that 10% and put it in another property, so it does make sense. Perfect, perfect. So also, when we do a second home, sometimes lenders tell us, you have to stay in your home for like 14 days. And then there's always this question about, should I talk to my lender about transferring it to an LLC? Should I not even tell them? And some lenders are like, don't, they're like, if you do that, we're just going to call the loan. So it's kind of, mixed reviews on that topic.
Yeah, absolutely. So the 14 days is not, well, let me backtrack. So for Fannie Mae, Freddie Mac conventional loans that
Mhm.
we're underwriting to those guidelines,
Mhm.
there's no set amount of days in there. It actually just says some portion of the year.
Right.
And so that's where I go back to just common sense. If by chance they ever looked that much into it or you got audited, you want to
Mhm.
show that, hey, we did use this property a few times a year. It could be, a couple weekends, maybe a week. but there's no defined number of days that's required. And it's only a 12-month occupancy agreement. So, when you go into it, you really want your intention to be that, hey, yes, our family's going to use and enjoy this property. Now, beyond the 12 months, if things change and what have you not, it's okay. You're not going to mortgage jail.
That's right.
So good.
Yeah.
And then in terms of the LLC, so this is also something I think a lot of loan originators just maybe they don't know they can look up or they don't choose to look up, but it's actually in the servicing guidelines for Fannie Mae. It addresses the LLC. And basically those guidelines say if you transfer to an LLC, as long as the person on the mortgage is majority owner or has control of that LLC, it's totally fine.
That's great to know. That's great to know.
Yeah.
Because most lenders don't have an answer for that. And we're just kind of trying to do that without telling the lender. And and then we're just nervous about calling the loan. So
Right.
that answers that question. A lot of our members are looking into buying condos, especially in the Florida market. So could you explain what that means in terms of lending, where it's different from single family homes to condo tells? And we often hear, warrantable condo, non-warrantable condo. So tell us more about condo lending for Florida.
Yeah. So that's a special topic.
Yes.
So there's a few things that go into it. So the first thing I would say is, I hope there's no realtors in here. No, I was kidding. I love realtors. They're great. But sometimes they just be careful when you go into a condo if the realtor tells you it's warrantable or not. They won't know because they're not lenders.
Right.
And this is crazy, but sometimes one lender may say something's not warrantable, but then another lender can get it approved.
Right.
It all has to do with interpretation of underwriting and guidelines for it to be warrantable. There's a few sticking points that nobody can get past, but basically what that means. So back in 2008, when everything fell apart and Fannie and Freddie were stuck with a bunch of mortgages, what happened was a lot of investors stopped paying their HOA dues. And then, so a big value piece of the condos is the exterior and the maintenance of the building. And so without HOA dues, they couldn't be maintained. And so the quality and value deteriorated quite a bit. So because of that, there are several different check boxes that have to be met for Fannie and Freddie to deem the HOA as stable, we could say, or, up to their standards. And then also if you're doing an investment occupancy loan, they won't allow it. It's not warrantable if there's greater than 50% concentration of investors in that HOA. But if it's a second home or primary home, that doesn't apply. So that's why it gets a little tricky. So on those, it's hard to tell up front if they're going to be warrantable or not. So part of the process is just, having the lender get those docs pretty quickly and get them to the team and see what comes of that. So I will say that we have an amazing condo team at Movement. And so we've gotten quite a few, it's been pretty rare that we've not been able to qualify a condo. We do have a couple non-warrantable products as well. So if it comes back as non-warrantable, I think it's 20% down on our second home, but the rates aren't actually that much different than conventional. So yeah, so when it comes to condo lending, it does get a little more touchy in terms of qualifying, but it can definitely be done. So don't be scared.
So we should, if we are getting into a condo, we should get you the HOA documents here sooner than later, for you to assess what kind of loan product will be best.
Great.
Can you still do 15% down though, or 10% down?
Yeah. Oh yeah, we can absolutely. Yeah, as long as it's warrantable, we can. And so, and you don't have to get the docs, just get us the HOA contact info, and then we'll do all the legwork. So you don't even have to worry about that. Yeah.
It's awesome that you have a team for that.
We do.
Makes our life much easier.
Yes. It's awesome. Like, can you stop saving lives and go find some condo docs for us?
Yes. I I know, right? I'm like, yeah, I bought a condo in the earlier part of my investing, and it was a nightmare to get everything lined up for the lender, you know.
Right.
So, but it's doing well, so it was worth it.
Good,
Yeah.
good.
Alrighty. So, we have a lot of questions about interest rates. I know interest rates play a crucial role in our mortgage market, and recently we've seen, that interest rates are pretty high. So, any advice on that, on interest rates? I know you have like no crystal ball there, but what are you looking at? What is your, foreseeable future looks like for interest rates?
Yeah, absolutely. So, one myth is that rates will come down when the Fed drops.
Mhm.
But rates are actually not directly, well, mortgage rates are not directly tied to the Fed. They influence them, but they're not directly tied. So they've actually dropped a lot already since October. October,
Oh,
ooh, they
wow.
peaked. They were ugly. Like primary homes were at 8%. Now we're down to about 7.25%. And they had dipped down last month to about 6.75. This is primary home rate, just to give you a better idea. It's easier to explain those.
Right.
And now they're at 7.25. So they've come up a little bit just because recently we've had the inflation data where it's not coming down, it's being a little stubborn. So people are kind of pumping the brakes a little bit.
Mhm.
But I think naturally my crystal ball. I would guess, yeah, I think they'll probably hold steady for a while, and then I hope they'll start to trickle down again as soon as we start seeing some of that inflation numbers. And it doesn't have to be, we don't have to wait until the Fed cut comes. As things start to improve, they'll go down. Now, conversely, though, if inflation doesn't improve or it starts to get worse, they could also creep back up. And so that's kind of where we are now. And I don't predict a refinance opportunity for another probably 18 to 24 months because even when they start to come down, you're going to
Mhm.
want to give them some time to really come down to a certain level before
Right,
doing the refinance.
right. That's great advice. Um, so for some of us who may be unfamiliar, could you explain what debt to income ratio means, and then how that matters to the mortgage process? And then what do you look at as a lender? What is the requirement for your DTI?
Absolutely. So we'll look at your gross monthly income. And we can do it. And, if you're married, we can do it with just one spouse, see if they qualify. I always recommend to go that route first or use both if necessary. And so we'll look at that gross monthly income versus the monthly obligations.
Mhm.
And then in terms of that gross monthly income, so we do not look at AGI on your tax returns. I have a lot of clients who are really concerned or afraid to even reach out to a lender because let's say one of them has a strong income, but the other, maybe they started a business that took a huge loss. And so they think, oh, my AGI, my adjusted gross income on my taxes was low, so I can't qualify. I want
Mhm.
you to know that if a spouse took a big loss or if you have big write-offs on your properties, none of that plays into your qualifying. So if you're a W-2 employee, we're going to look at your gross W-2 income and use that. If you're self-employed, there's a formula on self-employment that we'll take
Mhm.
um, and apply that number. And so we look at everything individually, property income, W-2, self-employment, it's all separate. And so it's a little bit of an intricate process, which is why I don't fear AI can take over our job anytime soon.
That's right. That's right.
Yeah.
So what is that cutoff? What number are you looking at? Is it 50% debt to income ratio? What is that good cutoff that we want to stay within?
So for a conventional loan, typically it's going to be 50%.
Okay.
If you're in that jumbo realm, typically 43 to 45% in the jumbo world.
Mhm.
Um, and then we also have bank statement loans. So if you opened a new practice or something and you have a year history of that, we can look at bank statements and qualify based on an average of deposits. And then there is also, and I didn't used to be a big fan of this. I like it better now when necessary, but there's the debt service coverage ratio loan, the
DSCR
DSC.
loan. Yeah, that was on my question list, but yeah, go
Oh,
ahead.
I'm sorry,
Yeah,
jumping
that's
ahead.
great. That's great to talk about that now. Yeah.
Yeah. So, it's become a better product. So we actually have a really strong DSCR product. There's no prepayment penalty. It's a 30-year fixed. And the rates recently are actually pretty comparable to conventional. I mean, maybe ever so slightly higher. So that product is a great option as well when needed. I would still recommend going conventional first if you could, just because the terms are a little bit better. But that debt service coverage ratio, and that's where, for those of you who don't know, that's where we look at the projected income of the property versus the payment. And we can use Hair DNA data for that. We could use a 12-month history if the property has a 12-month history. Or we could use an appraiser. We can have an appraiser do a fair market rent valuation as well. So we can use that data to determine that for the DSCR, and debt to income ratio doesn't matter. It's just the property ratio. That one.
Right, right. Would you recommend that once the conventional loans, you're saturated with your personal conventional loans, then to go there, or should we still look at it even before that?
No, I mean, personally, if it were me personally, I would max out my conventional loans before doing that.
Okay.
Again, just because the terms are a little bit higher. And if you don't need it, then conventional is just a stronger product, in my opinion.
Sure. That's great. That's great.
Mhm.
Um, and so some of us have questions about, working with local in-state lenders versus national lenders when we're securing a mortgage. Somehow we feel like if it's in the same state, we will get some, they may know the area better. Does that really make a difference? What would you advise our listeners for that?
Well, I'm a little biased.
Yeah.
Yeah, I think it depends on who you're working with. So there's a couple of us
Mhm.
loan originators that really focus on short-term rentals. So, for example, I'm licensed in 39 states, and I do just fine in all of those states. But this is kind of where it goes back to depends on who you're working with in state. So, if you're working with a really strong loan originator who understands, like, please don't call Rocket Mortgage. You're going to get
Right.
somebody who
Right.
probably doesn't know what they're doing. Or well, maybe they do, but probably not as in depth as you may need.
Right.
And so, yeah, I think it depends on the loan originator more so than the lender themselves. And the appraisers, they're going to be they're part of a network anyway that all lenders in the area are pulling from. So these aren't appraisers that are employed by the lender. They're all independent contractors. They contract with what do you call it? Appraisal management companies or AMCs, and then all the lenders use these AMCs. So there's not necessarily an appraisal benefit there
Right.
either. Um, so yeah, so it depends on who your national person is versus that market,
Yeah.
I'd say.
Yeah, I have the same opinion. I would rather go with somebody who's more of an expert in what they're doing rather than where they are located. It really doesn't matter. So that's excellent. So yeah, before we wrap up, any final tips to our listeners, particularly with short-term rentals, and then how can we reach you for our mortgage questions?
Yeah, absolutely. So I would really just encourage I think it's kind of, it's kind of like when I need to do my taxes. I dread doing my taxes and getting all the documents together and setting up the meeting. And then it just sits in the back of my mind forever. So I'm sure that's the case also with a lot of people and lending,
Right.
because it's like, oh, we've got to get all this info together before we have the conversation, see what we're qualified for. So I understand that. But depending on where you are in your journey and, how ready you are to be able to start looking, really encourage you to set up that call, get that info to help you, to help you kind of navigate where you're going to understand your numbers, what you qualify for, and to help you build out an initial game plan. Just like anything that can sometimes be tough, I think people procrastinate that. I know I would. Um, I also know that nothing gets you to get your taxes done faster than a property you want to purchase.
Right. Yeah.
So I definitely would encourage you guys, if any of you just kind of want to have a consultation, I'm happy, my team's happy, we can kind of walk through and see where your numbers are. I'm happy to also share with you, because I lend in a lot of different markets, happy to share with you some insight on some of those markets that I see from a lending perspective, um, as well. So yeah. And then, so I have a new website. So our group is called Wealth Builders Mortgage Group. It's part of, I work for Movement Mortgage. They're a national lender. But I branded our group because we specialize and focus on investors and short-term rentals. And so we have wealthbuildersmortgage.com. And on there you can set up a Calendly or submit an inquiry on our website, and we'll get back with you. And as far as loan originators go, it's myself, and I have a senior loan originator, Rob, who's also excellent. And then we have a team behind us. Once you're under contract, the team steps in and helps coordinate and get your loan from start to finish. So
That's great. I can attest to your team. It's excellent. I've had done three, mortgages with you so far, and I've done some with others. So I mean, I love it because your team is so like they are so into, they know what they're doing. So
awesome.
I'm like really relaxed.
Nice.
So that's excellent. That's excellent. So yeah,
Great.
I think that's awesome. Let me see if we have any questions here. So it looks like there's a question about HELOC.
Okay.
So we had a member who had a HELOC, and while they were going through that process, the underwriter did not consider his income and tax return to offset the mortgage payment for the STR that they own. They calculated his full 100% of payment as debt for the debt to income ratio. How do we manage this so his DTI is in good shape?
So they were trying to get a HELOC, or they counted the HELOC?
Right, right.
Okay.
We're trying to get a HELOC, yeah.
Okay. So HELOCs are a little different than traditional loans. So
Mhm.
typically those are going to be held, and the guidelines will be set by the bank they're originated through. And it's usually depository banks that do the HELOCs. And when I say depository, that's the kind of bank where you can have a checking account, savings account, where they hold money. And so because they are in charge of and hold that HELOC, they make their own guidelines basically. And so what I would say is I would encourage you to check with a different bank on that HELOC, because they all have different guidelines, and some may understand that better than others.
Mhm. That's awesome. That's awesome.
Yeah.
So we have a question about lending to LLCs and trusts. Is that something that your team can do possibly?
So the trusts, absolutely. I can't think of a loan program that we can't close in a trust. So trust should be fine. As far as closing the loan in an LLC, the only product that will allow for that is that DSCR product.
Mhm.
The others it has to do, they're not movement guidelines. They are national Fannie Mae, Freddie Mac guidelines or jumbo guidelines. And so those we have to close the loan in a personal name and the property in a personal name. But those are the ones you can quit claim the property to an LLC, but the loan would stay in your
Mhm.
name. And then for those, some people are concerned about that hurting their DTI. I just say, remember, it should only hurt your debt to income ratio until you get your taxes filed with that rental income showing. And then
Correct.
once that rental income is showing, that should offset your DTI, and maybe even help your debt to income ratio, depending on how much.
Right, right. So yeah, I remember when it was I had reached my DTI with my personal loans, and then when I filed my taxes, you told me, you could now get another one with your own name because now your income has increased. So that was good to know.
Mhm.
Yeah, that's perfect. Excellent. Let's see. Well, people are asking what's the current rate today?
2.99.
Investment home loan. Like what are you seeing on an average these days for a second home or investment home, personal conventional loan?
So the two rates that have been making the most sense lately are going to be 7.562, 799,
Mhm,
with 1 to 2.5 points, depending on
mhm.
loan amount, credit score, and that kind of thing. So that's
Right.
where they were. But what I will say is in October, I remember this very clearly because I cried
Mhm.
myself to sleep every night. Maybe not. But rates were like at 8.6 with over 3 points. And
Wow.
it was insane. So I know they're still not fantastic, but I am
Yeah.
grateful that they've come down quite a bit.
Right, right, right. And I also tell people not to focus on that little point, you know. I mean, like 7 or 7.25, it doesn't really make a difference in your cash on cash. I mean, you want to go with a lender that has a good process in place and you have less stress over your purchase rather than that little bitty point that you worry about, you know. So in the long run, it doesn't matter.
Absolutely. Thank you for that.
Yes, absolutely. All righty. So,
Can I ask a follow-up question?
yes, please.
So, the mortgage rate currently, uh, without the points, what would you what would you say? So the current 7.5 was with 1 or 2 points, right? You said.
Correct. So there's actually not for second home and investment, Fannie Freddie loans traded on the secondary market. There's not, well, with up to 20% down, there's not an option with no points right now. There really hasn't been for a couple years because it's just the way the secondary market works. So it's not movement getting it. It's not even Fannie Mae and Freddie Mac. What happens here? I'll nerd out with you guys for a minute here. Um, so here's what happens. So when a lender originates a loan, and a bank too in most cases. So if they do a Fannie Freddie loan, they fund that loan at closing. And then now movement doesn't have deep enough pockets to hold all these loans for 7, 10, 30 years. And so movement sells the loans and they're contracted to sell them to Fannie Mae and Freddie Mac. And then movement gets that money back and they can go lend again. Well, same thing for Fannie Mae and Freddie Mac. They don't have deep enough pockets to hold all these loans either. So this is where they bundle those together. And I'm sure a lot of you have heard the term mortgage-backed security market. So this is where they bundle those loans and they sell them on the mortgage-backed security market, which is basically the stock market for mortgages. And then investors purchase these loans. And so what's happening now and has been for the last couple of years is on a very small scale, let's say you have 10 loans at $100,000 each. So that total package would be worth $1 million. And so Fannie and Freddie say, hey, we have this $1 million mortgage-backed security. Who wants it? And so then investors will say, hey, we'll buy that, but we only want to pay $950. We want a $50,000 discount. Fannie Freddie need to sell it because they have to keep liquidity in the market. So they sell it. And this is why they're called discount points, by the way. It's not a discount for us, for anybody on this side of the process. It's a discount to the investor. And so what happens is Fannie and Freddie have to recoup that gap. And so they anticipate this pricing and then they pass it down on pricing to us. We pass it on to you. And that's where points come from. And the reason it's been that way for the last couple of years is because investors they also haven't wanted to increase rates enough on second home and investments to where there could be no points because they know rates will come down and then people would refinance and then they're not making any money. They're not making the interest anymore. And so the way it's been is the investor's way of making some interest before the refinance boom comes through, if that makes sense.
Okay, thank you.
Yeah.
There's a question about how long does it take to close the loan typically by your team?
So 30 days is really comfortable for everybody, we found. We can close quicker if we need to. We've saved a few loans where we've closed them in 7 days. Usually there's already an appraisal involved there. But 7 days is legally the soonest we can close. It's a federal regulation. So we can close within 7 days, but 30 days is pretty typical.
That's awesome. That's awesome.
Yeah.
And then another question about transferring to LLC. Do you recommend that can be done right away, or should we wait a year, or is there a timeline for that?
Nope, it can be done right away. There's not really a challenge with that. If you are buying in Florida or Pennsylvania, though, I recommend setting up a land trust because Florida and Pennsylvania, they're the only two states I'm aware of, but they actually charge a transfer tax
Yes.
that's substantial to quitclaim to your LLC.
Yes.
The other states are easy, though, but those two, for whatever reason, it's challenging.
Right. I've done that in Florida. I've paid the transfer tax twice.
Yeah.
Yeah, the land trust, I don't know, it's a little bit complicated. So, but yeah, that's right. That's always an option in Florida. Perfect. I think those are all the questions we have in our chat. Anybody wants to unmute and ask questions? We have maybe 10 more minutes here. Parker, could you drop your website on the chat if you don't mind?
Yeah. Let's see here. There. Huh. Wonder why that didn't do a link. Let me see. There.
Archita, can you unmute and ask your question?
Can you hear me?
Yes.
Okay. So I have a question. I'm sorry, I was also kind of doing some work on the side. Did you talk about cash out refinance and home equity loan? How does that kind of fit in the picture in all the financing scheme?
I didn't, so you didn't miss that. So cash out refi can be a great option. You know, I don't necessarily, well, depending on if you have a first mortgage now on it and what your interest rate is, it may or may not be the best idea to do a cash out refi if it's going to increase your rate a ton. But it is an option if you wanted to dip into some equity, or if you own something free and clear, that may be a good option. If you do have a current mortgage now that has a great rate and you don't want to refinance that, to your point, the equity line of credit can also be a strong option. And here's something to clarify too on equity lines of credit. In terms of debt to income ratio, when you're purchasing real estate after you get a HELOC, most products are not going to count. If you're not using any of that HELOC, most products won't count anything. So, you could have a $500,000 line of credit, but you haven't drawn anything. So that's not going to hurt your debt to income ratio. There's a couple jumbo products that are weird about it, but they're rare. So HELOCs won't hurt if you're not tapping into them. Now, on the other token, you can use HELOCs and the money from HELOCs to purchase real estate. That's an acceptable form of down payment. And then we would just calculate what that payment would be. And then it would count in your debt to income ratio if you're using it to purchase the new property.
Okay, thank you.
Hey, the question I had was, we are looking at property currently in Florida, and we need to have a pre-approved loan. So how does that work? So letter of pre-approved.
Yeah, so so typically clients will set up a call and then have them do the loan app ahead of our call so we can go through it. And I'm sure it's a similar process if it's with me or anybody. And then go through financials. And, in most cases, if you're dealing with a loan originator with confidence and knows what they're looking at, we'll be able to issue a pre-approval right then and there. On rare occasions, sometimes the agents or the seller want something that's been underwritten, which is a little extreme. Usually they do that if they had a bad experience with somebody. But in most cases, I talk to those agents and they've been fine with the letter that we issue, especially if your debt to income ratio is not anywhere near the top or where it needs to be. So yeah, so that's also just setting up a call. And then if you're self-employed or have rental income we need to use, we would need tax returns. If you're just W-2 though, we don't need tax returns, just like your most recent pay stub if we need to calculate bonus or any variable income.
Okay. All right.
Yeah.
Yeah, we are currently looking at few properties in Florida, and actually I'm flying out in few days
Okay.
to check it out. But I was told that you would need a lender's pre-approve to put offers on it.
Yes. Yeah. Because they'll want to know before showing you or before
Yeah.
accepting your offer. They'll want to know that somebody's looked at your financials and said you're good. So yeah. Yep.
All right. Thank you.
Yeah. And it's a quick process too. So typically I'll do like a 30-minute call and
Mhm.
knock it out right then and there and issue the letter at the end of the call. So
Okay. All right. We will do so. Thanks.
you're welcome.
All right. Anybody else has any questions? Otherwise, we'll wrap up here.
Hi, I have a quick question about the number of mortgages one can have. Can you hear me?
I can.
Yes, so that's what I wanted to know, that in the long run, does it make a difference if I apply for a loan only under my name versus both me and my husband? Does it limit us in the long run how many mortgages we can have?
Yes. So I do recommend, when possible, to finance it just under one spouse versus both to give you the most long-term flexibility. So when it comes to conventional lending and most jumbo products, the max number of finance properties in your personal name is 10 per person. So that means, let's say, I don't know, maybe you need both of your income to qualify for the first 3 properties. But then you get your taxes filed. So now you've got rental income. So now you're in a position where you guys can do them on your own. And so then in that scenario, you could each technically after that get 7 more. So you could combined in that example have 17 finance properties. Now that's specifically in your name. So if you were to finance in an LLC, like a DSCR product, that would not count against the number financed in your name. And then we do also have that DSCR product allows 20 financed properties. So that's another thing too. But yes, for the conventional and jumbo financing, I do recommend when possible just to put one of you on the mortgage. Both on title is fine, but just one on the mortgage.
Oh, thank you. Thank you so much for clarifying that, right? Because no one has ever been able to tell me that clearly.
Okay, good. Well, I hope that helps.
Thanks.
Underlining that, I do that too. So the property title is in both names, husband and wife, but the mortgage is only in one person's name. So that's, you can actually have it differently there. And I realized that very late in the game, but that's how I do it now. All right. Awesome, guys. I think we're up to the hour. So thank you so much again, Parker. I got to know so much more about you and your team. And so thank you so much for helping us out. And we'll reach out to you for further questions and, interests in mortgages.
Sounds great. Thank you very much for having me and allowing me to share, and happy to help any of you guys anytime. Appreciate it.
Thank you so much.
Thank you so much, Barbara.
Parker, is it wealthbuildersmortgagegroup.com or is it wealthbuildersmortgage.com?
They both go there.
Oh, okay. Well, even better. Okay. Thank you so much, guys. Thanks.
Thank you.
Bye-bye.
Thanks. Bye-bye.